So I have this topic for the next newsletter, but I thought I'd do a visual version of it for those that are visually oriented, and we'll see how this works. But it's on interest rate, inflation rates, stocks, markets, bond markets, how things are going and what's happening out there, and just help you understand a little bit of what's happening. Couple preliminary things that are always important when it comes to investing is, number one, how often do we have downturns? Quite often. 5% downturns in the market happen about 3 times per year historically since 1951, according to the Capital Group. They did some research on this. 10% downturns about once a year. So downturns are pretty common. When we think about it, if it weren't for downturns, I always say thank God for downturns. If we didn't have downturns, then the returns of stock markets wouldn't be any higher than CDs or treasury bills or something like that. So downturns are okay. And we look at downturns and how often historically have we recovered from downturns? And I always like to kiddingly say, we've recovered from 100% of them. So, I don't worry about it too much. You won't see me sweating over these things. But understanding them is kind of fun to get kind of a feel for how all of this stuff works. And by the way, anytime you change your investment portfolio, anytime I change, basically I'm looking around what's going on, what's happening here, what's happening there, it is by definition market timing. So we don't want to engage in that. So we don't make changes based on predictions or forecasts about the future, what's going on in Ukraine, what's happening in Russia, what's going on in China, or any of that. Now, one of the things I talk about in the newsletter is the Federal Reserve. What is the Federal Reserve? Well, that's our central bank. And when you make a deposit to, let's say, your bank account, 100% of the money goes in, but 100% of the money doesn't necessarily stay there. You may remember this from It's a Wonderful Life, where, your money wasn't in the bank. It was in Joe's house over here. So what happens is money goes in, and they may keep 10% of it in the vaults, and they go and send the other 90% out, and they re-lend it back out. Now, you hear an awful lot about interest rates going up and the federal funds rates and all of that. What the heck is that? Well, on a daily basis, banks are looked at and they're audited to determine whether they have enough money in reserves, that 10% that they had to hold back. If they are short, they may borrow that money from another bank, or they may borrow it from the Federal Reserve. So that's basically where the federal funds rate comes from. It's the interest rate charged to borrow money to meet the reserve requirement. Now, the Federal Reserve so indirectly actually affects interest rates. So you hear about the media saying interest rates are going up. Well, realize it's just that one. Interest rates in the markets actually went up before interest rates, the Fed actually raised interest rates. So you go, well, wait a minute. If interest rates in the market went up beforehand, who actually raised interest rates? Buyers and sellers of bonds. That's how it works. So it's an indirect process when it really gets down to it. Now, what's going on? Why is it the Federal Reserve says, hey, let's try to raise interest rates? Or what are they trying to put out there? Information about what's going to happen with the economy. Well, what's some of the information going on in the economy? That we have inflation. Well, inflation is what? Prices doing that, right? So inflation is prices going up. Now, to control inflation, we might have to raise interest rates. Why? Because if we raise interest rates, people borrow less money to buy houses. They may not make housing purchases, or they'll buy smaller houses, or they may put off a car purchase if interest rates are high, or any other number of reasons that, when we have interest rates go up, we may look at it and go, you know what, it just doesn't make any sense to buy something right now. When I don't buy something right now, that reduces demands for products. So if demand goes down, then what ends up happening is then there's not as many people buying that thing, which typically drives prices up. If demand goes down, prices can come down, and we can tame inflation. We saw this, Paul Volcker, back in the late 1970s when Carter appointed him. It was kind of the death knell of his presidency, because he basically said, hey, I'm going to raise interest rates. When he said, hey, I'm going to raise interest rates, that meant that the economy was going to slow down, and that meant that Carter's chances for re-election weren't great, and Reagan ended up winning. And then, even then, it took a couple years for the economy to get better. Then when the economy finally got better, Then all of a sudden, things started to look better for Reagan, and he ended up getting reelected. A little history there. Now, what happens with stocks and bonds is, let me just walk through that. With stocks and bonds, when interest rates go up, if they go up, stocks and bonds can go down. Now, I said can because it's not always a slam dunk for stocks. For bonds, yeah, when you have interest rates go up, bond prices will go down. And the reason for that is this. When I have $1,000 and I buy a bond, let's say that I buy that bond, and I think I calculated some number here, so I'm going to walk through a 5-year bond. Say I've got a 5-year bond, and that interest rate on that thing, I think I used in the newsletter, was 3%. Okay, so 3% is one of the interest rates that I use. Well, let's say if I said that my current rate was 1%. So I've got this bond, I pay $1,000 for it, it pays $10 of interest, which is 1% of 1,000 every year. So I get $10, $10, $10, $10, $10, and then when my bond matures, I get $1,000 back. Okay, so that's how a bond works. Pay $1,000, they pay me $10 of interest every year for 5 years with a 5-year bond, and I get $1,000 back. If interest rates go to 3, let's say over the next year, and there's a new bond out there that I pay $1,000 for, I could pay $1,000 for, or somebody else could pay $1,000 for in 1 year. And let's say it's a 4-year bond. So it's going to mature at the same exact time that this one matures. Now this one pays 3%. So it's $30, $30, $30, $30. Now the question is, who wants to buy your bond from you that only pays $10 per year? Answer, nobody, unless there is some kind of a change. What change does that have to be? Well, what has to happen is you have to say, hey, look, I really need to sell this bond. And I know you're in the market for the bond, and you could buy this one right here that pays $30 every year, or you could buy mine and I will charge you $908 for it. Now what happened for you is you paid $1,000 a year before, it went down to $908, you lost $92. So basically you lost money on your bond, and that's hence the bond prices going down when interest rates go up. Now what happens is this. Let's say if you're the investor that happened to own this bond right here, you only sell, or you only lose when what? You sell, right? So technically if you hang on to the bond and you don't go and get rid of it and panic, then what will happen is you'll continue to get your $10 payments for the next 4 years, plus you're going to get the appreciation because it's going to go from the $908 back to the $1,000. Now, if it's a government bond, it's backed by the federal government, so it's guaranteed as well. So if you look at this, you're going to get your money back. Your yield to maturity will still be 3% in this particular case because interest rates have gone up, okay? So that's a good reason not to panic, okay? Now, another thing that happens is this with stocks. If we look at stocks, we go, okay, so why do stocks maybe go down if inflation goes up? Well, in the newsletter, I use the example of Company A and Company B, and I joke about Company B. It's not the boogie woogie bugle boy of Company B. You know, if you're an older person, well, maybe you're a younger person that likes old music, you probably know what I'm talking about. But anyway, Company A, Company B, and Company A and Company B are competitors. And all of a sudden, inflation is starting to heat up, and now the dollar is worth less. If you are Company A, and you go and raise your prices first, guess what happens? Is the consumer goes out there and says, well, Company B is selling that same product for less. I think I'm going to go to them and I'm going to buy the product from them. And hence, guess what? As Company A, you lose business. So Company A doesn't like that idea. So maybe they'll be hesitant to raise their prices too fast. When they don't raise their prices too fast or fast enough, what will happen is earnings or profits will go down. I can spell. Earnings are going to go down. Why? Because they're charging less for something, and maybe their cost of goods sold and their operating expenses have gone up, and it will hurt their earnings. And what do I buy when I buy stocks? I buy the rights to the earnings. Well, what will that do to the stock price? Well, all else being equal, it's going to drive the stock price down temporarily. But eventually companies do raise their actual earnings by increasing their price. Eventually. They can't stay there forever. You know, you could buy a car back in the 1970s for $3,000. Try to find one now for $3,000 that's new. I mean, it just doesn't happen, right? Okay, so now another thing that we got to think about here is what about what areas of the stock market? Some areas of the stock market go down more than others. What areas would go down more when we have inflation? Just so happens to be the area of the stock market that Americans are enamored with, which is large growth companies, the big tech companies, and the big companies that everybody knows and loves and shops at because they're growing companies. Well, why do they go down more than anything else? Because a growth company is a company whose earnings are growing rapidly. And the way I explain that in the newsletter is you might have a company that has, and I used the example of, I think it was $1 million, right? I think that's what it was. Yeah, it was $1 million, the example I used in the newsletter. So they're going to have $1 million in earnings when? In 5 years. So they're going to have $1 million of earnings in 5 years. They're not going to have much in earnings right now. Fairly small company. You know, $1 million in earnings isn't much for a company that might be publicly traded. But what happens is if the discount rate, let's say that the discount rate is 2%. So let's say that is, and when you buy a stock, you're buying the present value, you're paying the present value of the future earnings. Because you're paying to get the earnings of that company. That's one of the biggest areas that you're buying when you buy a stock is their earnings. Now you're also buying their plant, their land, and their equipment and all that stuff. But just for sake of keeping this simple, you're buying the rights to the earnings. If the earnings are going to be $1 million 5 years from now, and that's the only thing we're looking at, is that one earning that's going to come in, and the discount rate is 2%, what's the present value of getting $1 million in 5 years if the rate of return is 2% or the discount rate? And the answer is $906,000. That's the present value, the value I would pay right now to get $1 million in 5 years at 2%. Boy, that's like really not neat at all. There we go. That's a little bit neater, $906,000. Let's say that the discount rate goes up to, I think I used 6%. Yeah, I used 6% in here. Let's say that all of a sudden now inflation has occurred and now my rate is 6. Now what will I pay? What will somebody pay to buy the right to receive this earning in the future? Remember, they're buying a growth company from me. What will they pay today? The answer is $747,000. Well, that's a 17% drop, as I calculated here. That's a pretty big drop because of what? Because of inflation. Now, so this is what you see, is the further out in the future that my earnings are going to come in, and when we have a big jump in inflation rates, the less those earnings are worth today, therefore the less the stock is worth today. So this is another reason why it's critical as investors to not put all your eggs. We've got small companies, we got large companies, we got growth companies, we got value companies. That's an L right there, large. It is critical not to put all your eggs in this basket. And unfortunately, the big mutual fund companies, that's where most of the money is. We've done studies on that, and that's what American investors put most of their money in, is that area right here. Whereas what we should be doing is, yeah, we should have some there, but we also should own that area, and that area, and that area. And these other areas, lo and behold, if we look at history, we have a higher expected return, but they don't necessarily move with that, and you can mitigate a lot of this risk by diversifying more. Now, last point I made in the newsletter, talked about stocks, I talked about bonds, and I often, in the past anyway, got a lot of this. Hey, Paul, why do we have cash in the investment portfolio? Why do we have to have cash? I mean, it doesn't earn anything. People would say that, and I go, yeah. Why? Why? Because stocks and bonds can both go down. And as we've seen, they do go down. So hence the reason we want to have and do have some fixed short-term fixed income in the portfolio is to help mitigate that risk and give us someplace that we can draw income from if you're living off of your portfolio, someplace I can pull income off of temporarily, because stocks and bond markets, we know, do come back, and it doesn't historically take that long for stock and bond, especially bond markets, to come back from downturns. So we have to have some place that's holding value while those other markets are down. And the other thing is, let's say you're not pulling income from your portfolio. It gives us some place that I can rebalance from. What I can do is I can take some of this cash and I can rebalance the portfolio, buy into the stocks and bonds that have gone down in value. And that is a big reason that we hold all three of these very distinctly different areas in a portfolio. So hopefully you understand a little bit more about how inflation and interest rates and the Federal Reserve and all this gobbledygook that you see on TV, how it all works. We'll catch you next time.